And we got folks hopping on in. Hope you guys are having a great start to your Saturday and your weekend. I know we had a long weekend last week with the Easter Sunday. Good morning, Lionel.
Am I good?
Good morning, Madam President. Thank you for having us. It's an exciting day, and we'll be getting a lot of information today.
What's the passcode?
Let's see. Good morning, everyone. We're getting ready to get started in just a moment. Hope you guys are having a great day.
Oh, my phone's right here.
Oh, what the hell?
Give us just one moment as our speaker is hopping in now.
Hold on. Give her the meeting ID. Mr. Hubbard.
No, she has it on her email.
What? No.
Aisha, can you see me? Hello? Hello? All right, can you hear me?
Yes, we can hear you, Marcela.
Oh, okay. Can you see me?
No.
Okay.
We can.
There
We
we
can
go.
Sorry, there's always a few little glitches.
No worries at all. Good morning, and thank you for joining us.
Good morning.
We are going to get started now. We have our amazing speaker, Marcela Garcia with Alameda Mortgage, who is joining us this morning. Before we get started, we are going to begin in prayer. Lionel, do you mind leading us in prayer?
Absolutely, Madam President. Father, we thank you for getting us together with this meeting today. We understand that many folks are taking time out of their weekend and their day. We pray that the information we receive today is really fruitful and is information that we can utilize in our lives. And we appreciate Marcela for joining this conversation to educate us. And with that, we praise you and we ask that you give us a wonderful meeting today. In your name, amen.
Amen. Thank you so much for that, Lionel. All right, we are going to go ahead and get ready for it with our presentation. Before we introduce our speaker and have her begin the part, we would like to introduce our Realtors team. And some of them are joined with us today. Myself as your president for 2023 year, Aisha Allen. We have our amazing past president who just gave us that a wonderful prayer, Lionel Okovi. Our chaplain, Mitch Shaw. Rosie Lopez, who is all joining us today, our treasurer. Jeffrey Hess, our first secretary. Sabrina Brown, our past treasurer. Krishna Lott, one of our amazing members, and another one of our amazing members, Annette De Dios. These are some of the amazing people that help us assist our attendees in the process of home buying and are ready to go if whenever you guys are ready to begin your home process. So today we have brought Marcela Garcia on to be able to explain more about some of the loan programs that are out there, and we will allow her to share that with you today. So I'm going to stop share on this and we are going to get the presentation prepared. Give me just 1 second while I pull it up for you. And I will hand it on over to you. It's good to go.
Beautiful. Thank you. Thank you everyone for joining today's video session. My name is Marcela with Alameda Mortgage, and I will be talking about the more common financing options that are out there for first-time home buyers, but also for second and third buyers, whatnot. But these are the most common financing options that are out there, and probably the more common ones that you guys hear about. So let's go over today's agenda. So I will be comparing and talking about conventional financing versus FHA financing. Then we'll move over and talk about Cal HFA basics and following Cal HFA loan programs, additional financing options, credit fundamentals, loan process, loan application documents, and then we'll have some time for Q&A. And if in between the slides, if you guys have questions, I believe Aisha can go ahead and let me know, and then I'll pause and answer any questions in between. But we also will have a Q&A at the end.
Yes, so please feel free to write any of your questions in the chat, and we'll be monitoring those so that we can answer those questions as we have the opportunity to do so. So feel free to go ahead and add those. Great.
Okay, so what is conventional and what is FHA? So these are, again, the more common financing.
Sorry, please go ahead.
So, and these are different investors. So to compare the two, I've kind of separated them and put them side by side, and I put I would say the biggest differences between them. But just so you guys understand the differences, these are different investors. So your conventional loan is sold to Freddie and Fannie investors, where FHA is a Federal Housing Administration loan. So that's backed by government funds. So those are the two differences, and they each have different requirements. So we as a lender have to make sure that the loan is sellable to each of those investors. So therefore we have to go off of their guidelines and their rules to qualify the buyer. So typically for conventional loans, the down payment typically is 5%. In some situations, we can do as little as 3%. And that usually requires a higher credit score. That would put you in a 3% tier, which is actually lower than FHA's 3.5. Also, one of the more one of the other differences between the two is the mortgage insurance. So a lot of people always ask, what's the differences between FHA and conventional? Well, there's mortgage insurance that's required on these loans, and this mortgage insurance is simply to protect the investor against any default, foreclosures, anything like that on the buyer, right? So these insurances are put on the loan in For conventional, it's only on there until a certain period of time, right? So this mortgage insurance is has the option to be removed, or they also give you the option to do what's called a single premium option. And so this mortgage insurance is added to the monthly payment. So if this mortgage insurance is removed, that means that at some point your monthly payment is going to decrease. Comparing it to the FHA loan, the mortgage insurance is on there for the life of the loan. And then just so you guys understand, when it's able to be removed on a conventional loan, it's when it reaches a certain percent of what we call loan to value or equity in your house. Once your balance is paid down to a certain amount, the investor no longer requires that insurance. So that's actually a really big difference between the two, especially because your payment will eventually be less once that mortgage insurance is gone. The credit scores are also different. So they have different credit requirements. Conventional, we can go down as low as 620 in certain scenarios. With FHA, we can actually go even lower than that. Again, certain scenarios, sometimes we'll ask for reserves, but those are typically the two differences as far as credit requirements. For conventional loans, there are faster processing times, at least in-house, right? We could get the loan moving a little bit faster. Also, sometimes with the appraisals, those come back a lot faster as well. There's different appraisers that are approved for FHA or conventional, right? Or some are not FHA approved. So there's a lot more appraisers out there for conventional as well. So just turn times just seem to be faster for conventional. So a lot of agents like, seeing a conventional offer typically over an FHA, just because of some of those benefits. And as far as the max loan limits, so you can buy a house here in the Fresno County. I'm using Fresno County limits on most of my presentation, so we're going off of realistic numbers. So in Fresno County, you can buy a house that, or at least your loan, you can finance a loan that is up to $726,200. So those are the new loan limits for 2023. Now moving over to, and again, this loan limit here is going to require the minimum either 3 or 5%. So that's a small percent needed on a loan up to $726,200. So now comparing it to the FHA. So the down payment for FHA is 3.5%. So that down payment can be lower, right, than the conventional option, unless they meet the credit criteria. Then with conventional, you're at 3%. But with FHA, going back to the mortgage insurance subject, so mortgage insurance on these loans will be required for the life of the loan. So the good thing about the mortgage insurance for FHA is that it recently decreased. So the mortgage insurances go off of a percentage, and that percentage is off of the loan amount. So recently, as of this year, just a few months ago, the FHA decreased those rates. So now it's more, again, to help the buyer with a more affordable monthly payment. So now that mortgage insurance is going to be less. But there is what we call a upfront monthly premium, as that also gets added onto the to the loan when you finance. So those mortgage insurance fees don't apply when you buy a conventional loan. So those are the differences with the mortgage insurance. A benefit for FHA that me as a lender, I like to use when we're trying to maximize a buyer's purchase power. FHA allows a higher debt to income ratio. So what that means is that we can use more of your income to qualify you, right? So in some cases, we can go up to 56% of your income, where conventional has a hard stop at 49.9, right? So if sometimes a buyer is like, well, what do I do to qualify for more? So then that's when we can compare the options, conventional and FHA. FHA, if you're allowed to go up to that debt to income ratio, then we'll get you a higher purchase power. With FHA, it does have a lower loan limit. So if you compare the two, the max loan limit for FHA is $472.30. And again, this is in Fresno County. That's a lot of information, but I think that covers most of the differences between the two. So if you guys have any questions on any of that, before I move on to the next slide?
No, it looks like we're good right now.
One thing that I
Oh, there
didn't
is
add
a
on here.
question. Go ahead.
Okay,
No,
one thing
go
that I
ahead.
didn't add to this, that is very important, the interest rates are also, they are pretty competitive, but they all are all different as well so you're gonna get one rate for FHA and you're getting another rate for conventional. So if you do qualify for the two, I always like to compare both options and let the buyer decide what they like and what's more beneficial for them.
One of the questions that is being asked is, what is the new mortgage insurance percentage?
It's 55% or 0.55% of the loan amount. So I'm gonna take my little calculator here and I'm gonna say, so if we're talking about a loan amount that's 300,000. So it's actually an annual fee, right? So that would be 1,650. So then we take that 1,650 and we divide it by 12. So that gives us 137,000 mortgage insurance monthly. Does that make sense how I got to that number?
Yeah, so you did the 300,000, we multiplied that by the 55%. And that gave you the 1,650, and then you divided it by the 12 months.
Yes. And so before I believe it was at 85. So it came down about about 30. It came down from 85, from 85 to 55.
Awesome. Another question that we have, and he said, yes, thank you, that did answer the question, is by Janice Vang, which is, what is the qualified credit for both? You mentioned a limit, but what is credit to qualify the 3% or 5%?
So that is, there's not a certain number, right? So the way the underwrite, what we call our automated underwriting system, it reads your file, your overall file, right? It reads your credit history more than anything, and it looks at your credit history, the length of history, your overall debt, but also your debt to income ratio. So there's a lot that goes into it. So I can't really tell you that a 660 is going to get you 3% or a 680. It really goes off of your overall credit history. But yes, the higher your credit score, the longer credit history you have, the higher chances of the 3% being approved with the conventional option.
Awesome, thank you. Okay, so those are the questions we have at this point. Would you like to move on to the next slide?
Yes.
Okay, awesome.
Okay, so now that we covered FHA and conventional financing, we'll dig into the CalHFA or CalHFA down payment assistance. So these programs are state-funded programs that will help first-time homebuyers with expenses when buying a house, right? So you can use this program for both FHA and conventional. So I think a lot of people think that when they're using CalHFA, it's automatically an FHA loan. Not necessarily. It's, you know, if the buyer wants to finance with the conventional loan, they can add on CalHFA to their conventional financing, or vice versa. They can use FHA with CalHFA. So you can use it for both. But for the most part, these are there's a list of requirements, right? But I'm going to put on here the most important one. So yes, you do have to be a first-time home buyer. The property has to be a 1-unit, and it has to be owner occupied. Condos are allowed, and manufactured homes with certain requirements are allowed. If you're trying to buy like a duplex or triplex, anything like that, that won't be allowed. And as far as owner occupied, everyone who's buying needs to be occupying the house. So you can't have a co-borrower that is going to live there, but you're going to occupy the house you're buying. So everyone needs to be first-time home buyers, owner occupied, living in that house.
In order to be on title for that.
In order to be on the loan.
Got it.
So, and then there is a homebuyer education course that is required when you use this program. It's really easy, and they give you 2 options. You can either do the course online, which self-paced, or there also are certain locations where you can go and take it in person. And once you're done with that course, there's a certificate that gets issued to you as completion, and then you meet the home buyer education course. And I have people who tell me it's pretty easy, they can knock it out in one day. Some people like to spread it out in different days if they're doing the online application, and then they they'll do maybe half one day and then knock out the rest at their own pace. And it doesn't have to be completed right away, but it just has to be completed before you close on a house. So typically a house, you're in escrow for about 30 days or so, so that gives you plenty of time.
Most definitely.
And I've never had anyone say that it was difficult or that they weren't able to do it. So it's actually really easy.
We have a few questions. Do you want to touch on those or you want to continue on?
Yeah, go ahead.
So one of the questions was, and I think I know where they're going with this, but they said they thought there was no money for the Cal FHA program.
So Cal HFA, this program here does have funds. So, and we'll dig into the program that currently does not have funds, but this program, Cal HFA, that I'm going to cover does, and it'll have the loan programs on the next slide.
Awesome. And then another question we have is, so if you use a conventional loan for Cal FHA, is there a second note or lien?
Yes, and again, we're going to cover that on the next slide, which goes in depth into what those programs are and how they're set.
Perfect. Okay, did you
So
go ahead?
Is there another question?
Nope, there isn't. Not
Okay, so for FHA, the minimum credit score for this program. So we have to qualify the borrower for conventional FHA. Once we determine that they're qualified, well, now we need to make sure that their score meets Cal HFA's minimum requirement. So if you're using an FHA loan, your credit score needs to be at 640 in order to use the program. And if you're using conventional financing, your credit score needs to be at 660. And that goes for all the borrowers that will be financing.
Awesome.
Income limits. So yes, there are income limits to use this program. Again, I went off of Fresno County's income limits, which are actually pretty standard. There are higher limits if you're buying like in the Bay Area or the coast or down in LA, but for the most part, Fresno County and surrounding counties is 159,000. So whoever will be buying on the loan, if we have husband and wife, we want to make sure that their joint income does not exceed 159,000. Which actually in my opinion, I think they're set pretty high. So most people do qualify. So the max DTI, which is debt to income, right? The ratios, that's what allows us to determine up to how much you qualify and how much of your income we can use. So if your credit score falls between 640 and 660, we have a hard stop at 45%. That means we can't use more than 45% of your income to qualify. Now, if your credit score is above 700, then we can use up to 49% of your income. So we have a little bit more wiggle room to get you to a higher purchase price.
Okay, so we do have two questions.
Okay.
One of them in regards to education course. You did talk about getting some education in order for it to count to be able to qualify for some of the loan programs. And someone is asking if this counts as an education course. And I kind of know the answer to that. So it's not the same type of a course. What are the courses that they have to take in order to qualify?
Yeah, so we actually send you a link to the course, and it's a course that's approved by the Cal HFA program, and it's HUD approved. So they will only accept the education certificate from those HUD approved agencies. So we send you the online link, and then we also send you the registration if you decide to do it in person, and it's going to send you to a HUD certified agency. So yeah, this one does not qualify as a education course.
So when does that happen? Is that something that happens once they sit down and meet with you and they decide which programs they want to use?
Typically I like to send it to the buyers once they get into escrow, right? Again, still about 30-day process, so it gives them enough time to do it. But if they wanted to do it before, yeah, they most definitely can. You know, they can get a head start and knock that out of the way. There is a fee for it, so I typically like to tell people to start it once they're in escrow, once they know that, you know, they're buying a house. But they're more than welcome to take it prior to that as well. So anyone that wants the link, we can always share it with them.
Do you know about how long the course takes to complete?
Well, if you start to finish, like sitting there, I think it's self-paced. But I've had people knock it out like in 2 hours, less than that.
Okay.
So.
Nice. And in regards to these programs, the Cal FHA programs that you've been discussing, is there a minimum income amount?
No, there's not a minimum, it's just a max, but your income again will determine what your purchase price is. So just as long as you're not making more than 159,000
Combined income.
combined income.
Okay, great. And then we do have another question is when two people are applying together, how is the credit score calculated? That's actually a really good question.
That is a really good question. So when there's two scores, we always look at each individual score, right? If it's, well, I guess it can be looked at in two different scenarios. So we'll look at scenario one. So if we have husband and wife joint credit, it's going to give us 3 scores, right? Which is from each credit bureau. So we take the average score of the 3. If you have 2 separate buyers, so if you have dad and son, right? We're going to have 2 credit reports. So then we look at dad's average score, and then we look at son's average score. And then those 2 average scores, we take the lower of the 2.
Okay. So if someone had a 680 credit score, and then the other person had a 530 credit score average, you're going with the 530 credit score average.
Correct.
Okay.
Yeah.
And then we have another question. What if you have a credit score that is within 2 credit limits? So this kind of answered that question. Within 2 credit limits, 660 and 700, would that be the percentage, the 45 or the 49%?
Yeah, so we would go off the lower of the 2. So
Okay.
that's 660.
Okay. You're controlling the keypad.
Me?
Yeah.
I'm not moving anything.
Okay, let's see if we can stop and regain control. Excuse us.
Is that you or me?
No, I don't know what's going on right now.
Ah,
Excuse us. Let me see if I can get out of here. And give us just one moment and we'll pull up the shared screen. Thank you for that information, and please continue to add your questions to the chat so that we can get those answered for you. But you guys do have some great questions. There is another question that is listed, and what is the lowest credit score that we can work with?
For Cal HFA, it's going to be 620, and we would have to go FHA that route.
Okay, perfect. Oh, sorry. The lowest income. My apologies. Yes, thank you for the correction.
What's the lowest income?
Yes, the lowest income to qualify for programs. Is there a minimum for any of the programs?
Yeah, though there's not a minimum. There's just a max limit. So, but there's no minimum. So as long as, again, if you don't make more than 159,000, anything under that, is going to be fine, but that income is going to determine the size of the loan, size of the house.
Got it. Okay. Shall we move on to the next slide?
Yes, now that we're back on track. I don't know what happened there. Okay. So these are the programs that are available currently with Cal HFA. And these have actually been around for some time. So they're not new, but I'll go over them as much as possible. It can get a little confusing. So if I need to stop and answer any questions, again, let me know. So when you are financing for either FHA or conventional, your lender is going to ask you for a minimum down payment, which we covered, right? So with conventional, that minimum may be 3 or 5%, or with FHA, it may be 3.5%. So Cal HFA has a program called My Home. So that's the first one. And My Home can be combined to help cover your down payment. So this one will be in second lien position, because first we're going to have your first financing option, which is either going to be conventional or FHA. That's going to be in first lien position. So if you decide to do My Home's going to come in second lien position. And so that second loan amount is going to be up to 3.5% of the sales price. And so that's what we call a silent second. So and it has deferred payments. So that loan will not require you to have any payments. And that money is what we use towards your down payment at closing. There are, however, repayment terms on that money. So it's an assistance, right? So it's not a grant, it's not a gift. So at some point we'll have to be repaid, and the repaid terms are either when you sell the house, if you ever sell it, you pay it from the proceeds of the house. If you ever need to refinance the house or do a cash out to take money out of the house, that second needs to be paid as well. Or if you do neither sell or refinance at the end of the 30-year term, because these are 30-year loans. So at the end of the 30-year term, then that note will be payable in full. And so My Home is going to assist with that 3.5% assistance of the sales price. But when you repay it back, it does have a small interest on it, and it has a 1% interest. So that interest will be until it's paid. So it's not a lot, but the amount of assistance that it's going to help you with, here's an example. So if your sales price is $400,000, that means that My Home's going to contribute $14,000. Any questions on that?
So far, we have none listed.
Okay. And so the other program that they have is called Cal HFA's ZIP. It stands for Zero Interest Program. So the My Home has a 1% interest on the repayment. This one is zero interest. So this one, you can either get 2 or 3% of the total loan amount. So for example, if your loan amount is $400,000, sorry, if your purchase price, we're still going off of the purchase price. If your purchase price is $400,000, you're getting that My Home, which was the first one that we just talked about. It's $14,000. So this one here, you can combine it with My Home. So now you're going to have your first, which was either FHA or conventional. You're gonna have your second lien position, which is My Home. And now you have the option to add a third, which is the ZIP or zero interest program. And so if you decide to do all three, combine all of them together, the zero interest, you can choose between either the 2 or the 3% assistance. So in this case, if you're buying a house of $400,000, I did the numbers I calculated here are for conventional, so I did it with 3% down. So that means that your loan amount is $388 after you leave that 3% down payment. That means that if you do the max, which is the ZIP 3%, you're going to get an additional $11,690. So you have the $14,000 for My Home plus the $11,640 from the 3% ZIP. Or you can do the 2% assistance. So instead of the my home, you would do my home with an additional 2%. Now, you may ask like, well, why would I go with 2% over 3%, right?
Yeah, why?
The interest rates on your mortgage are going to be different. So when we look at what rate you will have, we have to go off of CalHFA's interest rates, right? And so they have a price sheet and they list it on their website daily. So if you guys are ever curious to know what the rates are, those are available to you guys, and you guys can always go on there and look. So the interest rates will change. So the higher the assistance, the higher your rate's going to be. And so we can look at examples if you guys are curious to know what today's rates are. But that's the way these two programs can be stacked together. And again, this one, the ZIP, which will be in third lien position, it's going to be interest free. So whatever money they assist you with, when you repay it, that it's going to be repaid with the same amount that they gave you. So this one has no interest on it. And the repayment terms are the same as my home. So either if you sell the house, if you ever need to refinance the house, or at the end of the 30-year term. Questions? Was that complicated at all? I know it can be a little confusing.
And always know that you guys can schedule an appointment to meet with Marcela directly if you'd like to get more financing questions and to go over your own particular loan options. That way she can answer questions specific to your needs, and taking a look at your overall needs. But at this time, no, we don't have any.
No questions?
Okay, there is one question.
I have a question.
Go ahead.
Can the loan be paid off sooner? Does it have to be like once we refinance or sell, or can it be paid back before any of that happens?
Yes, absolutely. So you can repay it back at any time. So you don't have to wait for
absolutely.
You don't have to wait for the repayment to kick in, right? If you sell or refinance, you can pay it prior to.
Awesome, thank you.
Okay, so and someone else had just asked, I guess, the same question, very similar to that one. Yeah, sorry, you said this is a no additional interest rate for repaying the zero interest program.
The ZIP, yes, it's zero interest. So if you are
zero interest
assistance for the 11,640, that's exactly how much you repay back.
And then we have another question. What are the fees when talking to a realtor or loan officer to go over documents, requirements needed for purchasing a home?
So that would be like a pre-approval. There's no fees to get pre-approved. So we always encourage you guys to reach out to us with your questions. Consultations are free. So we can, guide you, walk you through the home buying process, get you pre-approved at no cost.
And it's the same with a realtor in regards to having a consultation and having a conversation. Most realtors do not have a fee associated with sitting down and discussing what your purchase options are and preparing for that purchase. The fees that come into place come when purchasing, and it's really just dependent upon how the contract is written out for the home that you're interested in writing an offer on. And so all you would need to do in that case, it really just depends on the home. And mostly if a home is listed on the market, there has already been a payment for the buying and selling agents already in place. So that would be something to discuss with your realtor at that time.
Yeah.
All right. I think we're ready for the next slide if there's no more questions.
Sure.
Okay, so this is a hot topic.
Yeah,
right
this
here,
is
right?
it.
So this is the program that I think someone had just asked about if the funds had run out. So this one, yes. So this one unfortunately came and went really fast. And this is the CalHFA Dream program. It literally lasted 2 weeks, actually maybe even less than that. So this program by far has been the most that CalHFA or CalHFA has ever assisted with. So they were giving up to 20% assistance. That's huge. So of course, before it even before the program even started, we had people lined up that were like ready to apply for it. And the 20% assistance, you could use it towards your down payment, but you could also use it to cover down payment and closing costs, right? So literally you could have came out like 0 to nothing out of pocket. This program, however, was only available for conventional buyers. So you could not use FHA with this program. So you had to qualify conventional, and then you would use the 20% assistance. It had a lot of benefits to it, right? Because not only are they giving you a big—
Oh my God, I'm about to go!
Excuse us.
not only are you getting a large amount of assistance, but they're also bringing down your payment significantly with that assistance. So your monthly payment, is going to be hundreds of dollars less. Also because you're no longer needing the mortgage insurance premium, which we talked about earlier. That mortgage insurance monthly fee that's included in your monthly payment was removed because that 20% down payment was being left. So again, people were hopping all over this. We were getting calls left and right, and it just came and went so fast. It was, we couldn't believe how soon the funds ran out. However, just to explain a little bit more about how the program works. So yes, you're getting 20% down, but just like the other program that we just talked about, it does need to be repaid. It's not a grant, it's not a gift. So the 20% was deferred just like the other loans are. But the repayment on this one doesn't have interest on the 20% itself, but the program will hold what's called a 20% equity share on your property. So that means that if you come to sell your house, or at the end of your 30-year term, the program's going to reappraise your house, and they'll look at the new value of your house, and they're going to compare it to the value from when you bought to the value of when it's repaid. And the difference between that is your appreciation. So how much your house has gone up in value. So the program will hold a 20% equity share. So if your house, say your house appreciated about 100,000, let's say 5 years, actually this example here, perfect. Right, the little picture underneath, if you look at it. So this is an example. If somebody bought their house and sold it 5 years later, and the value has gone up 100,000, they're going to pay back a 20% appreciation. So on top of the 20% down payment, they're also paying back 20% appreciation to the program. Does that make sense?
Yes.
Okay, so there was a lot of questions regarding what ifs, right? What if my house didn't appreciate? What if my house actually lost value? What if the program was so new? Even we had to reach out to the Cal HFA program and have them answer questions for us. There was a lot of unknowns. But if the house did not appreciate, then there was no appreciation to pay back. However, you were still responsible to pay back 20%. I have to take a drink of water. So with that being said, that program is no longer available. However, we are being told that Cal HFA is currently doing some research on their pipeline of all the loans that were reserved or locked with those funds. They want to make sure that there's no errors or any funds that are not being used after all. So they will notify us if in the future they will re-release any funds and open up that program again. But as of right now, it's fully reserved and it's not available. And our last Cal HFA down payment assistance program is the USDA program. So this one here is a 0% down program. So if you happen to find a property that's eligible for this program, you can buy it with 0 down. So your only expenses are going to be your closing cost. There's a map where we look and to make sure that the house is eligible for financing. for the most part, it's going to be houses that are in a rural area. So this is a rural program, right? So if you are looking to buy like Sanger, Fireball, Kerman, Madera Ranchos, anything that's pretty much like outskirts or rural area, this program's gonna be for those homes. There is a website, so if you're ever curious, you can type in the address and it's going to tell you, yes, this property is eligible, or no, it's not. It has to fall within the zoning limits. And with this program, so we talked about how FHA's mortgage insurance premium just reduced to that 55. So this USDA has a rate that's even lower than that, right? So that means that the monthly premium on that mortgage insurance is even less. And this one is at 35, so 35%. So it will give you, it will have your overall monthly payment will be less. USDA on top of the 0% down, you can also combine it with My Home. So if you guys remember from the last slide, My Home was the first program that we covered, and that's the one that would help with 3.5% of the sales price. So on top of the program being 0 down, which means you're already not coming in with a down payment, so 0 out of pocket, those closing costs, if you needed assistance with covering those closing costs, then we would add on the My Home. Right, so again, little to nothing out of pocket with this program.
And that is layering it and stacking it with which one, the Cal FHA USDA program?
Yeah, so we would do the Cal FHA USDA, which is 0 down, and then now if they want assistance with the closing costs, then we stack it with the My Home.
And so then the 0 down, there's no cost, they're not paying for that. USDA is covering the cost for that. And then the closing cost would be that silent second, correct?
Yes. So we would have USDA would be your first, and it's just a government loan. And then My Home would still be in second.
And so we do have a question in regards to that. And is the mortgage insurance for the USDA for the term of the loan?
Yes, it is.
Okay, so the only way to get out of the mortgage insurance would be to refinance into a conventional loan? To
refinance, yes. But again, that monthly premium is actually the lowest. So it's at 35%. It's going to be pretty minimal.
And then, and Susanna, your question is how much will we need to repay? Repay of which amount? The USDA loan, or if you were to do like the financing? You can feel free to unmute yourself to ask your question.
From USDA. So USDA you're not getting assistance for the down payment. They just don't require a down payment. So you can finance 100% of the house. So you don't have to, there's nothing to repay back. You're financing 100% of the sales price. So your only responsibility would be to come in with your closing cost. So you would only repay if you're adding the My Home, which is to cover your closing cost expenses.
And so that's like certain areas that qualify for the USDA program.
Yes, again, it's rural, right? So that's why it's not so common, because it's I mean, like if you wanted to buy here in Fresno, the properties wouldn't be eligible for it.
Do you know there's some areas, what areas currently kind of off the top of your head?
Yeah, so all like if we're talking about Fresno County, so all like the surrounding counties like that are rural, like Fireball, Mendota, Kerman, Kings. I know the Madera Ranchos, like outskirts of Madera, like Chowchilla area are. I mean, but yeah, there is a map, so we can share if you guys are interested in those rural areas, we can share the website, and you guys can go in there and see, you know, what's eligible and what's not.
And we will actually be sending an email after this event. We can share the link to the video. That way you guys can replay it at your own convenience. And then we will also have Marcela's contact information listed in there. And we'll add a link to the USDA website so that you guys can check. And it is per property. So once you find a home that you're really interested in, you can definitely add the address to the website and find out if it is a home that qualifies for the USDA program. But Janice, yes, I do believe Fowler is considered one of those areas that, as far as the USDA areas. Marcela?
Yes. Yeah, I've seen homes in Fowler.
Okay. And they're asking, and she's also asking, would it be eligible under the conventional or FHA? For power?
USDA is its own financing. So USDA is neither.
Okay. Perfect. Shall we move on to the next slide?
Yes.
Okay.
Okay. So aside from the conventional and the FHA with the down payment assistance programs, I made a list of other financing options that are available. They may or may not pertain to you guys, but if you guys, maybe know someone, or, in the future, you guys, think about any of these other options. There are a vast amount of financing options. So, when somebody comes in, we almost always find a home for them. So it's just everyone's scenario is different. So we always look and see what the best and more beneficial financing options for you are. But if anyone on this call is a veteran or currently active in the military, thank you for your service. There are VA loans that are available, and those are also zero down. So that's a huge benefit to a VA loan. And then also, there's really no max loan amount. So, the VA loans are super lenient. The credit scores, we can go down as low as 600. It does have to be a primary owner occupied home. But the mortgage insurance, which is what we covered with the conventional and FHA loans, on VA loans, they waive it. So there's no mortgage insurance on these loans either. So this is a really good program as well. If anyone is interested on more information on a VA loan, I'd be glad to go over that with you guys individually. And then there's the jumbo loans, right? So we went over the loan limits for conventional and FHA. So if you wanted to buy a house for that exceeds those loan limits from conventional and FHA, then what we would use is what is called a non-conforming, what we also call jumbo financing. So that means that it exceeds that $726,000 loan amount, right? And so here in Fresno County, this is the limits on where we would start using jumbo loans. Typically because they are larger loan amounts, and these they do require a little bit more, right? So the credit criteria is a little bit more stricter. The reserves are required, where typically on conventional and FHA they're not. Sometimes they'll last for 6 months, sometimes even 12 months, right? So it just depends on once we run your underwriting decision. The minimum credit score is 660 for these. It's available for primary, no second homes or rentals. So again, this is jumbo. So if you're looking to make a bigger purchase that exceeds $726,200 in the Fresno area. And then there's also what we call non-QM. These are pretty popular, I would say, more for the self-employed clientele. They're tailored a little bit more for that type of a buyer, but there are other financing options outside the box of your standard conventional and FHA. So the bank statement program is probably our most popular. So for example, someone who's self-employed and doesn't want to use their tax returns, right, because the way they file, or the income on there is not what we can qualify them with, we can actually exclude tax returns. So in this scenario, we would use our bank statements to qualify them. So we would ask for either a 12-month or 24-month history of their bank statements, whether it's a personal or business account, and we add up all their deposits, right? And so we take an average of those deposits, and that's the buyer's income. So we would go off of that bank statement income to qualify. There's also the 1099. So again, if you're self-employed, you're going to get a 1099, and we exclude the tax returns, and we just take an average of either that 12-month or 24-month average of what your 1099 income is stating. There's also ITIN reporting income. So if someone does not have a social security number, but they do file their tax returns with an ITIN, we can also help finance them. And then the investor or DSCR loan is only for investment properties. But again, we exclude tax returns, and we only qualify the buyer off of what the property rents would be. And there's a few more options, but this is just a quick little rundown of other options that are available that are, again, outside of the conventional and FHA box. So this is, again, tailored more for the investor / self-employed buyer. Any questions?
We have a question, but the question is about another loan program, and I'm not sure if you're even familiar with the program that Bank of America has in regards to their down payment assistance program. Are you familiar or have you heard of it at all?
I don't think I'm familiar with it. What's the name of it?
It's just a grant program that they have, the home grant program. The issue is, I'm sorry, they have, it's believe it's a total of 17,000, and they have 2 programs that can be used together to be able to qualify for those programs. And I think one of them is listed at 13,000, and then the other is $4,000. I'm not really sure. We do have a contact for you, Marcelo, and I can send you that email. That I can also add their contact to that email that we send out to you guys after we follow up, to be able to reach out to them directly to answer any of your questions if you would like to do that. Okay, perfect.
Okay.
I'll actually add that resource to the and their contact, and we'll send that out to all of our attendees. So all of you that are on the call will send their link, their information to there. They do have maximum loan requirements as well for that program. So that is another thing that we will have to look into, see if it's something that you guys would like to be able to qualify for. Yeah, there's another program that is out there, which is called the WISH program. I'm not sure if that's the one that you're considering, but that one is up to 22,000 in grant funds to be able to qualify for that program itself. We do have a speaker that will be joining us next month. I believe it's the 15th of next month, and she will be discussing the WISH program and the financing requirements for that program as well. So please be sure to hop on and join us for our next workshop as well, and we'll have more of that information for you guys as well. Okay, Marcela, should I?
Yes.
Awesome. Yes, we will definitely add that information for the next event as well in that email.
Okay, and then really briefly, I just wanted to talk about credit fundamentals, right, which is really important when we look at your credit. I would say that's the number one thing, that the lender or investor wants to look at as far as qualifying you. They want to make sure that not only are you repaying your debts as promised, right, but they want to look at your credit history to see, what type of buyer are you, right? Are you responsible to make your payments on time? Do you have how long is your credit history? How many credit inquiries do you have? How much debt do you owe? So they look at a pretty thorough review of your overall credit. It's not just a credit score, right? So it's something to keep in mind. I always tell buyers, the investor doesn't know you, the lender doesn't know you, right? So your credit does speak for you when it comes to buying a house. It's just really important. So here's a quick little chart, and it gives you a breakdown of the importance of your overall credit. So if you look at the 35%, that's going to be your payment history. So for example, if you have late payments, if you have collections, any of that type of derogatory history, that takes a good chunk of your credit. So that can easily bring your credit score down. So I always tell people, avoid late payments at all costs. And so I think a lot of people have the misconception that if you make a late payment by 2 weeks, that hurts your credit, but technically that's not true. So you have up to 30 days to make a payment with your creditor. If after those 30 days, no payment is received, then they report you to the credit bureaus. Then that's when it hits your credit. So by all means, if you're going to be late, be 1 or 2 weeks late, but make sure you make that payment before the 30 days, because once it hits your credit, it's really hard to get your score back up. But with that being said, there are ways to work on your credit. And so Aisha actually asked me to talk about what we do here at Alameda Mortgage to help buyers get their score up. So we're not a credit agency. We're not a credit repair. We don't repair credit, but there are things that we can do to help you increase your score and maybe get you to where you need to be if you're not ready at the moment. So let's go on to the next slide and look at a quick example of what we can do. So it's called, Aisha, can you go to the next slide?
Yes.
It's called a rapid rescore. And so this here is actually a perfect example. So Aisha, when Aisha asked me to pull up numbers on someone's rescore, this person actually was the most recent one that I thought about. And I said, yeah, I actually have one that I just did not too long ago. And there's another buyer that is actually Aisha's client. We're working on a rescore for her at the moment. But this buyer here, when we first started, I ran her credit. And if you see, you're going to get 3 credit scores, right? Which is 1 from each bureau. So Experian had her at 604, TransUnion had her at 656, and Equifax had her at 688. So we looked at her credit history, her, the outstanding credit cards that she had, the credit limit and the credit balances. And we have this option right here, if you see where it says potential score improvement. So we can actually go into the this website where it gives us scenarios if they were to pay off certain cards or certain loans or pay down certain balances, how much their score would improve by. So in this case, Experian was telling her that she had a potential of increasing her score by 36 points if we did a rapid rescore. And, same thing for TransUnion and Equifax. They give her score improvement here. So I gave, this client's name was Elvia. I gave her the options on what cards to pay off to get the credit score improvement. And she actually went a little bit further and did more than what she needed to. So if you notice, her score actually increased dramatically. So she went from a 604 to a 685. And then from TransUnion, she went from a 656 to a 745. And Equifax was 688 to a 768. And so all this was done literally from the time that I pre-approved her. And then she was still okay with these scores, but she wanted a higher credit score to improve her mortgage insurance premiums and to also ensure and improve her interest rates. So by the time from when I pre-approved her, she went out and started shopping. She got into escrow. And then she was also working on paying off those debts. So by the time she got into escrow, she already had those paid. I believe it was about a 2-week period that she was able to pay those off. And then I rescored her, which typically takes about a week or so. So within the 30-day process of her escrow, her score improved, and now her payment was less because we were able to, 1, improve her rate, and 2, bring down that mortgage insurance premium. So there are things that we can do to help you guys with those credit scores and with the interest rates and to try and lower your monthly payment. Some people may not have the means, right, to be able to do it in such short period of time, but for those who can, we can definitely do it. So it has to be, the rapid rescore has to be done within 30 days of us pulling your credit in order for it to work. The sooner we do it, the more effective it is. So that's the way a rapid rescore works. Any questions?
So Janice, you asked a question, will there be a credit workshop in the next meeting? We actually, the last meeting that we had was a credit workshop, and we had a credit specialist join us to review options. So that was something that we did have in the past. And if you'd like a contact to actually work on, and otherwise, another thing that we like to do is actually have you sit down with the experts themselves, like Marcela, who is will be the type of person to qualify you for the loan. And I feel like it's great to sit down with the lenders themselves who are going to get you prepared for buying, because they're the ones who know what metrics you need to meet. So we could even schedule an appointment, Janice, with Marcela, and she can pull your finances, take a look at it, and see what options would be needed to be able to help increase your score, if there is anything that you need based off of what your goal is or what programs you're trying to qualify for. We have another question. Marcela asked if, will the changes show since lenders only report monthly?
So this is what a rapid rescore does, right? So it gives us the ability to increase your scores much sooner instead of having to wait for those payments to report with the credit bureaus, right? So we do need you to provide proof of those accounts being paid. So if once we go over your credit report, if you think that it's not doable within 30 days, then we just let you pay it at your own pace, right? And then yes, we do have to wait for them to update, whether it's 30 to 45 days with the creditor and the credit bureaus. But with a rapid rescore, we don't have to wait that. So literally, as soon as you pay off the debt, so if I tell you, hey, you need to go pay down your Costco card, to $0 or to $100, bring me back a statement, updated statement, or an online account balance that now shows your accounts at $0, and I will use that to submit in my rapid rescore request. So we gather all your documents. As soon as you pay it, you send it over to me, and then I send that request in. So then they're going to use that balance that's on that new document, and they'll update the payment, and they'll rescore you right away. So there is no time, we don't have to wait. So this can only be done within 30 days of pulling your credit. So as soon as we get those documents in, we send it in, and it's updated right away.
Perfect. Another question that we have is, do you guys look at medical history as well as does it affect your score?
So actually, that's a good question. So as of, I believe it was last July, maybe I might not have the date right. But this is actually recent changes where medical collections no longer affect your credit history. So they don't affect you the way one of your credit card collections would. So no, the collections for medical purposes, they don't affect your credit score anymore.
Perfect. And then Susanna, yes, you can get Marcela's contact information. She is located here in Fresno. We will be adding her contact information to our follow-up email. Again, in that email will be listed. We'll have the link for this video for those of you who did not get the opportunity to watch it through, or you can share it with friends and family. And then as well as we'll have the information for our upcoming workshop for you guys to be able to attend. And again, we will be covering the WISH program at the next meeting. And then we will also have our contact information in a job form. So if you're ready to move forward with your process of home buying, whether that's just sitting down and talking to a lender or sitting down and going through a buyer's consultation to prepare for your home purchase, we'll have that link in there for you to fill out your information, and we'll reach out to you with next steps so that we can proceed. And again, do not worry about if you're ready to buy today. You don't have to be ready today. We would like to sit down with you as soon as possible so we can execute your game plan and do some of the repair items if the need be to prepare you for your purchase. But you can be ready 6 months, a year down the line, or 2 years down the line. Myself, Marcela, and our team are definitely open to assisting you at your pace. Would you like to move on to the next slide?
Yes.
I know we're
Yes.
running it. We're just about
Yes.
out of time, so we
I think
can.
we're almost at the end here.
Perfect.
So this really quickly is just a loan process breakdown. So this takes you through, from start to end on the process of buying a house. So I won't go too much into detail, but just so you guys know, this is a 30-day process typically, right? Sometimes, if we need to make your offer more attractive or be more competitive, then we can, crunch that time down to 2 to 3 weeks if needed. But for the most part, 30 days is your typical close of escrows, right? So we get you pre-approved, which is your interview with your lender to determine how much you get pre-approved for. You submit your documents. Once you're pre-approved, right, then your lender would order any appraisals, verification of employment, any prelims on the property, right? Any documents that we need to submit your loan to underwriting. So then we submit your loan to the underwriter. They will re-review everything that your lender did at your pre-approval, right? And so once they review your loan, they're going to give you an approval, and they may give you a list with a few items and say, minimal requirements after your approval. So those items are what we call final conditions, right? So once those final conditions are in, then you get a final approval. Then the underwriter will say, okay, they've met all the conditions, loan is approved. We can now move over to the closing department. Closing department orders your final loan doc, so which has all the final figures on what's needed to close. Then we send those loan docs over to the title company, right? So then the title company will set up your signing. Once you sign your documents, the documents are sent back to us for another review. And that's when once the documents are reviewed, then we prepare for funding. So we will fund your loan. Once the lender funds your loan, then we send the recording confirmation to the title company. That's them sending your deed of trust to the county recorder's office for official recording. And once that's received, right, then all the funds are dispersed, we close, and congratulations, you've just purchased a house. So that's a quick little rundown from start to end on the purchase process. Next. Okay, and if any of you guys are interested in getting pre-approved, these are the documents that you want to have ready for the lender to pre-approve you. They will be the most recent 30 days pay stubs, your W-2s from your last 2 years, as well as your tax returns for the last 2 years. If you're self-employed and you have business tax returns, if they are like a corporation, right, partnership, like those type of filings are separate from your personal tax return. So we always ask for business and personal. The bank statements, we would ask for the last or the most recent 2 statements, and then a copy of your government photo ID. So those are all the items needed to get a pre-approval or a decision on how much you would be qualified for.
Would you like the next slide?
Next slide. Okay, and I think that's all. You guys, I appreciate all the questions that you guys asked. If there are any additional questions, I am open to answering any questions, whether it's via phone, via email, shoot me a call, send me an email. I'm more than happy to connect with you guys. There's a lot more information to cover, right? But I wanted to make sure that we covered the basics. And I hope that you guys have a better understanding of the financing options that are out there for you guys. There are other down payment assistance programs, but we don't have the time to cover them all in this call today. But they are pretty similar to CalHAFA's assistance. So if you guys want information on those, Aisha is providing my information. So you guys are more than welcome to reach out to me and we can cover those individually. Other than that, I appreciate you guys being on this call. Thank you guys so much. And I look forward to helping you guys.
Yes, most definitely. Thank you guys all for joining us. Again, we will send up a follow-up email today with Marcela's contact information for you to contact her directly. She works with Alameda Mortgage, but here in the city of Fresno, California. But she is licensed to operate. Marcela, where can you operate out of? What areas can you service?
Anywhere in California, and I am licensed in Texas, and we do have a few individuals here in the office who are licensed in other states as well. So if you are looking anywhere outside of California or Texas, we can definitely connect you guys with someone here in the office. Yeah, and so if you guys don't know where we're located, we are right on the corner of Bryant and Fresno, right next to, let's see, there's a Wells Fargo here, and then there's the Heirloom across the street from us. And then the Dave & Buster's is in the same parking lot. So right off the 41.
Awesome. Perfect. Thank you guys very much again for joining us today. Hopefully you guys did find this information very informational. We will send up that follow-up email with the information for you guys to reach out and for your next steps and to proceed. Thank you again, Marcela, for all of your information, your input.
Thank you for inviting me. I appreciate you.
and working through that, some of those items for us to give us some examples of how to work on credit and those other options that are available. Thank you for your expertise. I'm always grateful and honored to work with you. And thank you guys all for joining us today. You guys have a great one. And
Have a
we'll
great day. Thank you, guys. Bye.
send you guys the
Thank you.
follow-up email. You guys have a great one.